Hello everybody and welcome to the webinar, Unlocking Tax Savings for both middle-class families and the affluent with Charitable Lead Trusts. What we're going to cover today is who you can help. It's not just going to be the ultra-wealthy or the affluent. We're always looking for more planning opportunities. We're going to free up some of your clients' cash, try to make those assets sticky, and we're going to cover some action items that you can implement to determine how to use this with your clients and which clients it's best suited for. Again, I'm Michael Redden. I'm a wealth planning attorney here in Minnesota, and I do estate planning and asset protection with also some tax planning in there. That's what wealth preservation is. I'm a member of the Society of Trust and Estate Practitioners, STEP, that's the international body, and I'm also a member of Wealth Council. So, again, the main benefit is you're going to have more planning opportunities. Tax reform inflated that standard deduction, so most folks are going to be just using the standard deduction and not taking the mortgage interest rate deduction or any charitable deductions. So what we're going to do is we're going to create a lot more planning opportunities because we're going to put your clients into that standard that itemized deduction category so that they can free up a lot more of their income. And when we free up that cash, instead of paying it to the government and the IRS, you can put it under your management and grow it just like you've been doing. It's better for your clients and they're going to achieve their goals faster. It also makes it sticky because money that are placed in these trusts for these planning strategies is going to have to stay in there for a term of years. And you're going to be involved every step of the way. These trusts are often going to be designed with you as the financial advisor for the trust. So it's going to stay under your management with you for quite some time. And often it's going to give you a touch with the next generation because a lot of times these plans will also dovetail with their estate plan. And who can you help? Well, basically you can help some folks with low assets, but a lot of middle income, affluent, and of course the traditional ultra wealthy clients. So why are we looking at these charitable lead trusts? Well, a lot of our clients are going to face large tax burdens. Those can come from unusual income events or just being too successful with your retirement savings. And since tax reform eliminated most of the deductions, all that's really left out there is some mortgage interest deduction and some charitable deductions, but you don't have access to those when you don't itemize, and the vast majority will not have enough of those deductions to actually itemize. So how do these trusts work? Essentially, the client is going to put money into the trust and get a tax deduction. The trust is going to pay some money to charity, and after a certain number of years, that money is coming back to the client or to some kind of trust for estate planning purposes that the client chooses. So the client gets to help a charity, get a deduction, and still keep quite a bit of their money. And in many cases, they'll even get back more money. So they'll put that money away, help a good cause, and get even more money back. The charitable deduction for cash donations is 60% of the AGI, and capital gains property is only 30%. So capital gains property would be if you had stocks in there that had a low basis, but instead of liquidating them and recognizing the gain, we just gave the stocks directly to the trust, then you can only deduct up to 30% of your AGI each year. But a lot of times we're going to liquidate it so we can get that 60%. And that deduction is going to carry forward for 5 years. So if you got a $500,000 deduction, but only $100,000 got used, we have 5 more years to use that extra $400,000, and that's going to be where you have even more planning opportunities to offset income and gains. The deduction is going to depend on the trust design. We can play with how much money goes to the charity each year, how long the trust lasts, and how much money we put in. So I could put $2 million in, and maybe I get $100,000 deduction, or maybe I get $1 million, or I can, in many instances, get the full $2 million. It works for small amounts as well, $300,000, $100,000, depends how you design them, and the client's going to get back whatever's left at the end of the term. And with the way things have been going lately, a lot of those clients are getting more back, putting $2 million in, getting 2.7 back, things like that. So if you have a client you think you might benefit from this, give me an email. I'd love to talk about their situation and the planning opportunities you might have. So now let's talk about some typical Minnesota clients. First, we're going to take the one you might not be thinking about for the strategy, the middle income client, and we'll finish with the traditional one. So that was Bill and Jennifer. They're both teachers, and the rule of 90s gave them really good pensions, and they also happen to be good savers. So they have $700,000 in an IRA and $300,000 in a non-qualified brokerage account, and their combined income is $110,000 a year. Now, with their RMDs, because they've got those generous pensions and they were good savers, in their 70s and 80s, they could have $160,000 in income that's coming from those RMDs and that retirement account, and that's quite a big tax burden. We want to convert some of that qualified over into non-qualified so that they just pay capital gains, and we can do that with this trust. So essentially, we would put $300,000, as you see on the left-hand side, into the trust by liquidating those non-qualified money. We're going to assume a 5.5% growth rate on the trust, and the trust is going to pay out $5,000 a year for 20 years. So the charity is going to get $300,000, but because it grows at 5.5%, there's actually going to be $352,000 coming back at the end. And of course, that depends on your market cost and your term. And what's that going to do for taxes? Well, the $170,000 in gains are going to be added to the $110,000. That's going to be $280,000. This was a cash donation, so we get to deduct 60%, or $168,000 in the first year. When you take that out of that $280,000, their income now becomes $112,000. So they only get $2,000 more in taxable income that first year, and now we have $132,000 left of that $300,000 that we can pull out of that qualified. So there's $132,000 less now, and its growth that's not going to be taxed at the ordinary rate. So you can see that we can do this and convert some of that qualified to non-qualified and get a nice tax advantage and help a good cause. So let's talk about the affluent client, or the wealthy client. This is the person you traditionally think about for this trust. Greg and Mary are executives. Mary works in the C-suite of a medical device manufacturer. Greg's an entrepreneur. Now, for their financial picture, they've got $2 million in stocks. Greg and Mary have $2 million in 401k plans. They're in a 37% tax bracket. But the reason why they're planning is Mary's going to get about $3 million in stock options this year as compensation, and that's going to create a very much unexpected tax bill. So we're going to have them pay $2 million to the trust. The trust is going to be 20 years, so not the whole $3 million, just $2. So we can get a $2 million deduction, and it's going to grow over 20 years. And since we expect it to grow more than we pay out, as you see there, we expect them to get $2 million or more back. That depends on the market, of course, and cost and term of the trust. Well, so without the trust, they would have paid 37% federally and 9.85% on $3 million. So about $1.4 million total in tax. We're also not including the net income investment tax. But without that, the client's going to pay 46.85% on that $3 million. Now, after the trust, we're going to have that 60% come out the first year. So 1.8 of that 2 is going to be deducted. And that's going to essentially result in $1.8 million of those stock options not being taxed at all. And there's also $200,000 we can use for future years to offset income and other things. So what's about the result? $1.2 million in taxable income, total tax between federal and Minnesota of $562,200. So that is $843,300 in net tax savings as opposed to that $1.4 million that they would have paid. And the client basically is going to pay a 28.11% tax rate on that $3 million, and the money comes right back to them at the end of the trust, and we help a good cause. So what do you need to do next? Well, review your clients who face high income liabilities in retirement. Review the clients that are going to expect large income events this year. Determine which one of those will not need the money for 5, 10, or 20 years. And then you can call me and we can design a trust to propose to your clients to get them back in those itemized deductions, plan, and put them in a much better tax environment this year and in the future by planning for that in the future. So if you need experienced help in this area and any of these things sound like they might help your clients and you want to talk about it, give me an email or give me a call there. My number's on the screen. We can talk about it. We can go over any other kind of planning options you might have had and determine what might be best for your clients. And we'll do some good planning. We'll help your clients, and we'll also help them achieve their goals and keep your assets under management. Thanks.